Today's episode, Next Week's Market Outlook, where we unpack the key drivers, risk points, and strategy ideas for the week ahead in U.S. equity markets. Whether you're a long-term investor or an active trader, the goal is to give you a clear frame for what to watch, what could move markets, and how to position, or at least think about, your portfolio. So, let's dive in. Segment 1. The current backdrop. Before we look ahead, we need a quick snapshot of where we are right now. The major U.S. equity indexes remain in a bullish environment. For example, the SPY ETF, tracking the S&P 500, is trading at around $664. Stock market information for SPDR S&P 500 ETF Trust. SPDR S&P 500 ETF Trust is a fund in the USA market. The price is $664.39 USD currently, with a change of 3.46 USD, 0.01% from the previous close. The latest open price was $659.47 USD, and the intraday volume is 96,500,870. The intraday high is 665.67 USD, and the intraday low is 551.41 USD. The latest trade time is Friday, October 17th, 18:15 MDT. The tech-heavy QQQ, NASDAQ 100, is near $604. Stock market information for Invesco QQQ Trust Series 1. QQQ Trust Series 1 is a fund in the USA market. The price is $603.93 USD currently, with a change of 3.73 USD, 0.01% from the previous close. The latest open price was $697.61 USD, and the intraday volume is 72,424,872. The intraday high is 605.46 USD, and the intraday low is 590.14 USD. The latest trade time is Friday, October 17th, 18:15 MDT. The blue chip DIA, Dow Jones Industrial, is about $462. Stock market information for SPDR Dow Jones Industrial Average ETF. SPDR Dow Jones Industrial Average ETF is a fund in the USA market. The price is $461.78 USD currently, with a change of 2.16 USD, 0.00% from the previous close. The latest open price was $459.36 USD, and the intraday volume is 8,439,860. The intraday high is 463.09 USD, and the intraday low is 454.47 USD. The latest trade time is Friday, October 17th, 18:15 MDT. What's powering the upside? A few things. Strong earnings in key sectors, especially financials and tech. Banks recently reported a sharp increase in profits year on year. The Wall Street Journal. At the same time, the International Monetary Fund, IMF, recently upgraded its U.S. growth forecast to about 2.0% for 2025, citing the AI investment boom. AP News. On the monetary policy front, the Federal Reserve appears to be moving toward a more accommodative stance. Recent comments from Chair Jerome Powell flagged concern about labor market softness and signaled perhaps 2 more rate cuts this year. AP News. So, broadly, you've got growth optimism, strong corporate earnings, and some easing expectations on policy. This is backing the equity market, but that doesn't mean there aren't possible speed bumps. Segment 2. What are the key themes for next week? Let's lay out 3 major themes that could drive market behavior next week. Theme A. Data-driven policy steering. Next week, markets will be watching for incoming economic data, in particular, inflation, employment, and consumer sentiment, that could shape the Fed's path. The exact economic calendar items are light thanks to recent disruptions, e.g., government shutdowns, but they matter nonetheless. Kiplinger. If inflation comes in hotter than expected, that could increase pressure on the Fed to delay rate cuts or even raise them. Conversely, if we see softness, particularly in employment or consumer spending, it strengthens the narrative of cuts ahead. Given the strong equity backdrop, a surprise in either direction could trigger a meaningful move. Theme B: Tech and AI momentum versus valuation risks. The AI investment theme has been a strong driver. Chip makers and tech names are getting the benefit of renewed enthusiasm. Reuters: But with momentum comes risk. Valuations are elevated, and if underlying earnings or guidance disappoint, we could see a rotation or pullback. Also, in this kind of environment, leadership breadth matters. Is the rally broadening beyond a few big names, or is it concentrated? A concentrated rally is more fragile. As one weekly outlook noted, the technical picture is bullish, but near-term cautious on tech due to stretched indicators. Schwab Brokerage. Theme C: Geopolitics, trade, and external risks. While the U.S. economy is a dominant driver, external shocks can still rattle markets. Trade tensions, for example USC-China, remain on watch, as do commodity and energy shocks, regional banking or credit concerns, and the potential for policy surprises. For instance, rare earth export restrictions from China recently rattled chip stocks, even as AI optimism was intact. Reuters. In short, clean macro data plus strong earnings equals tailwind, but weaker data, policy surprise, or external shock equals risk of correction or rotation. Segment 3. What to watch. Key events and data releases. Here's a practical list of what to mark on your calendar for next week. Consumer Price Index, CPI. The release was delayed, but it remains a key event. Market watchers will judge whether inflation is still sticky, and this will impact expectations for the Fed. Kiplinger. Weekly jobless claims and employment data. Softening labor market metrics would reinforce expectations for Fed cuts. Strong data might cool those hopes. FX Street. Earnings updates in key sectors. Tech, industrials, and financials remain in focus. Even if fewer marquee names, guidance is what matters now. Fed speeches or comments. While there may not be a policy statement next week, remarks from Fed officials will be dissected for clues. Geopolitical or trade headlines. Any unexpected trade escalation or supply chain shock could quickly change the backdrop. From a technical and structural perspective, market breadth, sector rotation, and yield curves are all in focus. Are yields rising, which can dampen equities? Is the curve steepening? Are smaller stocks or non-tech sectors beginning to catch up?
Segment 4. Risks and potential scenarios. Let's walk through a couple of plausible scenarios and how the markets might respond. Scenario 1, base case, probable. Soft data plus continued corporate strength lead to moderate upside. In this scenario, we see employment softening, inflation remaining tame or even easing, earnings in line with modest upgrades. That would reinforce hopes for Fed cuts, supporting equities. We may see further gains, though perhaps more modest than recent thrusts, and possible rotation into value or non-tech sectors. Scenario 2, upside surprise. Strong data plus upbeat earnings. Risk of overheating. Here, inflation or employment comes in strong. Companies deliver above expectations with aggressive guidance. The good news is markets rally, but the risk is the Fed shifts hawkish again. Yields rise and valuations get challenged. In that case, we might see tech stumble and more pressure on growth stocks. Scenario 3, downside surprise, weak data plus earnings miss plus external shock, pullback. If inflation spikes unexpectedly or employment plunges, or there's a geopolitical or banking shock, the risk-off tone could creep in. In that environment, broader markets may stall or decline, rotation to defensive sectors increases, and risk assets get repriced. Other risks worth noting: over-concentration in a few names, which increases fragility, a surprise from the banking or credit sector, regional banks, etc. External, commodity shock, trade shock, China slowdown. Segment 5, strategy ideas and what investors should consider. Given the currents and potential paths, here are some strategic considerations for the week ahead. Stay diversified, but monitor leadership. With tech and AI still prominent, consider whether the rally has broad legs. If leadership is narrow, examine whether rotation into other sectors makes sense. For example, industrials, value, small caps. Manage exposure to interest rate risk. With the Fed front of mind and yields having implications for valuation, monitor your equity allocation in relation to bond yields. If yields rise significantly, growth names may suffer. Use pullbacks to reassess rather than panic. If markets pull back, view it as an opportunity to reevaluate positions rather than panic. New consolidation or correction could be healthy rather than disastrous, but still use risk controls. Watch the calendar and set alerts. Given the outsized impact of macro data now, make sure you're alert to data releases and commentary. If CPI or employment surprises, it could move markets swiftly. Consider hedges or alternatives. If you're worried about downside, look at hedges, puts, inverse ETFs, or diversification into non-equity areas. Commodities, cash, alternative strategies. Also consider regions or sectors undervalued when rotation occurs. Avoid over-leverage in narrow themes. While AI and tech are exciting, they've run ahead in many cases. Make sure you're not overly exposed to highly speculative, high-valuation names without a solid earnings backdrop. Segment 6, final thoughts and wrap-up. So as we head into next week, the market appears set for more gains, driven by corporate strength, a friendly monetary policy setup, and the AI investment theme. But it isn't without risk. Key triggers, inflation data, employment, earnings, Fed commentary, and external shocks. From a tactical standpoint, the trend is bullish, but near term we may be in the high breadth but moderate upside phase. If you're taking new positions, lean into sectors that could benefit from rotation, value, industrials, emerging markets, but also keep tabs on the safe asset and hedge side. To summarize, bullish backdrop remains intact, but valuations are elevated and the risk of rotation or pullback is higher. Important data ahead could shift the market tone rapidly. Strategy should be balanced. Participate in upside, but manage risk actively. Use any market wobble as a chance to reassess, not a panic trigger. Segment 7, Quick Fire Market Snapshot. Here's a rapid update on key sectors and assets. Technology and AI, still the front runner, but watch guidance and valuation. Financials, strong earnings in major banks are a tailwind. Smaller regional banks still under scrutiny. Consumer, services. If employment and consumer sentiment soften, this area may get hit. Commodities, energy. If inflation surprises, commodity exposure could hedge, but excessive inflation could hurt growth stocks. Bonds and yields. Yields creeping higher may act as a drag on growth names. A flattening or steepening of the curve gives signals about growth or inflation expectations. Geopolitics and trade. Unexpected trade disruptions or supply chain hikes remain unknown unknowns, but still material. Segment 8, your key takeaways. Before we close, here are the 3 key takeaways I want you to remember for next week. Data rules the tape. Any unexpected number in inflation, employment, or policy commentary could change the narrative quickly. Participation matters. The rally is healthier if many sectors are contributing, not just a few mega-cap tech names. Keep eyes on the breadth. Stay nimble and risk-aware. The landscape is bullish, but complacency is risky. Have a plan for both upside and potential pullback. That wraps up this week's PyUncut Outlook. Thanks for tuning in. If you found this episode helpful, please subscribe, leave a rating, or share with a friend. Next week, we'll revisit how these stories played out, dig into any surprises, and talk strategy for the fourth quarter.